Hello, everybody. Kirk Spano, Retirement Income Options, Monday, January 6th, 2025. Few housekeeping items for the rest of the year and maybe forever. Monday will be exclusively Retirement Income Options from here on out. Going to try to keep the call to about 30 minutes, teach you how to sell options, and give you my ideas for the week and what I've been doing at my firm. I think that is the best use of our Monday time. This coming Wednesday, we have the monthly major markets overview, ETF asset allocation, and question and answer with Scott, Teresa, and myself. That will be Wednesday night, so make sure you sign up for that. And then all the other videos that I'll be doing, I'm just going to record on my own time. I'll be doing stock updates, stocks of the week reviews, and interviews. And in fact, I have 3 interviews planned. We're going to talk to a money manager from Amplify ETFs, which is where my brother works now. And he, I never brought anything from Northern Trust to you or from Vanguard, and he's worked there too. But the Amplify ETFs, I think there's a couple that are interesting. So we're going to take a look at those. Also going to talk to Cambria Investments, which is Meb Faber. And it looks like I'm going to interview either Meb or his fixed income guy or both. So we'll see. I hope it's both. And they have a ETF, it is a bond ETF, and it's a tactical bond ETF. So if you don't want to try to manage the bonds yourself, but you know that you should have an asset allocation to bonds, especially if you're like an 80-20 investor, where you always want to keep about 20% of your money in bonds. And again, I don't think anybody should really go past 20% in bonds ever. I know the 60-40 thing is a thing. I think 80-20 mathematically is the way you want to go if you're looking to mitigate risk, but still keep most of your upside. So at 80-20, we know that the performance of an 80% equity, 20% fixed income portfolio is almost as good as 100% equities, but with a lot less volatility and waviness. And on crashes, on stock market crashes, if you want to plow that 20% of bond money that probably did well during a stock market crash in the stocks for a year or two after a stock market crash, that's a pretty good trade usually. And then you just move back into the bonds as interest rates go up again. So we'll be doing that. And then I have a couple of other interviews with other analysts that are coming up. I am interviewing Cody Willard next week, I think. So Cody Willard, who was a Fox business analyst. Cody Willard is a hedge fund manager again, and he's over at MarketWatch still writing for them. I think on a weekly basis, but it might be a little bit more or less than that. All right, retirement income options. I'm writing an article now, and I'm updating it a little bit so we can keep track of things better. Now that I kind of understand how to write this piece in chart format, I'm going to do just one section. Cash secured puts, recent and outstanding, and the notes you'll want to pay attention to. The one that I already wrote right here. Let's see if I can get this to highlight. Ooh. So in the last update, I said that I had rolled my $90 end phase puts from January, I believe it was, out to May, and it cost me a couple of cents. I may have even made a couple of cents, don't remember anymore. But the net price was $12.01. The net premium was $12.01. I bought these back just now, so I marked this for you, and I closed this at a slight profit. Why did I buy back the end phase puts? The stock market is playing out to the theme, to the plot that I laid out, where it's rallying right now. The first day started up and then ended up about flat, but the last couple days have been up. So far, the year is up, already 2%? And a lot of stocks have rallied. I still see global liquidity turning over. So if you take a look at some of the posts I've put out, global M2 money supply has been coming down for about 6 months, 9 months now. Generally, there is a 6 to 12 month lag before asset prices turn over. So we are heading into the window of seasonality ending on the positive side sometime in the spring, as well as kind of an extended period of M2 money supply going down. And until that heads back up, I think there's a pretty good chance that we get a 3, 6, 9 month mini bear market or, if things fall off a cliff anywhere, could be worse. The one thing that you should be aware of is a lot of the weaker stocks that I've been harping on for years about the zombie fication of the S&P 500. While they have good balance sheets and they have decent profits, the reality is that revenue hasn't really been going up, and prices on the stocks have been going up because margins expanded a little bit, and I expect that to continue because of AI, but really because valuations went up and up and up. There was enough money in the system to chase stocks. Well, when global money supply comes down, that ends. Foreign direct investment last year was really high in the United States, the highest ever. That's going to turn over. Why? Because people overseas have less money as money supply tightens up. Very simple Econ 101. As money supply goes down, asset prices on a 6 to 12 month lag eventually head down as well. And then when we get our bear market and maybe a recession, then the governments print money again and M2 goes up, and then all the assets follow. This is a 100% correlation sort of event. There is no exception in history where with what I just said being untrue. Every single time the global money supply goes down from 6 to 12 months, there has been a decline in global asset prices, mainly stocks, but also real estate and commodities, often because the entire economic cycle stalls out or heads into recession. So in that environment, what am I doing? I'm selling a lot of covered calls. It's not something that I do very often. However, we are ripe for selling covered calls. So I have been doing it, selling a whole bunch of them. And I'm going to add some targets here from what I just did over at Interactive Brokers and at Schwab. So you can see since Friday, I've been pretty active in the option market. You can see here that I closed that end phase. I hope that you can see that. I bought back my innovative industrial puts. Why? I still have the stock position. I'm not going to sell that. However, I made a small profit on the put position. I took it. The Intel covered calls, I closed because I wanted to sell new ones, and those executed today. So I got $1 for selling the April $25 covered calls on Intel. Stock was up a little bit today. I think these were trading at like 78 cents or 80 cents on Friday when I put this order in. I put the order in at $1. So I'm going to make 4% of my money over the next 3 months. And again, this is shorthand math in my head. There's 4 3-month periods in a year. So you just multiply 4% times 4. My annualized return is 16%. Beats the hell out of any dividend, right? So if this expires and at some point, maybe later in the year, the stock price, goes back up, I could sell it again. And you're really generating huge incomes compared to what most dividends are going to pay you. Now, people go, oh, but I have a portfolio of 8 and 9 or 10% yielding preferreds and convertibles and BDCs and blah, 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 blah. Well, those are incredibly high risk. In most cases, there's a handful that aren't high risk, but most of them are. You automatically should think high yield equals high risk. Why? Because that's historically what it's always been, and it's never different this time. So if we get a liquidity turnover, if we get a mini recession, the high yield stuff will get the shit kicked out of it. And one of the reasons why I'm introducing a Cambria fund to us, a tactical bond fund, is because they play in that sandbox. And what they are doing right now is very similar to what I started talking to you about a month or two ago. I bought the intermediate term treasuries, right? Those 3, 4, 5, 6, 7 year bonds, because there's not a lot of downside or upside, but you're collecting a 4% plus yield, basically dry powder. And if interest rates eventually get cut, which they will someday, probably in 2026, you're going to see a capital gain on top of that coupon that you were collecting. So we are actually close to wanting to buy long-term treasuries so that we can get a bigger capital gain, but I'm waiting for just a little bit higher interest rate on the 20 plus year bonds. What the tactical fund at Cambria does is it does it for you. When risk is low, it'll buy into the high yields. And when risk is high, it rotates out and it goes into shorter term US Treasuries or even T-bills. And right now it is 100% in T-bills, so short-term stuff. And that is because they are very concerned about the fact that we have the narrowest spread ever right now, narrowest ever between high yield debt and treasuries. So you're really not getting much to go out on the risk spectrum versus US Treasuries. So why would you do it? All right. So I sold and a couple of new options. I bought back a bunch of them. I had some covered calls on Unity. There was more. I must have gotten rid of a couple more. The day that Roaring Kitty maybe talked about Unity, I took my covered calls back in because I do think that Unity is eventually $100 stock again. I just don't know when. So I decided, if they're gonna turn Unity into a meme stock, I don't want that covered because I don't want it getting called away from me the way that Palantir did when it went from overvalued to super overvalued. And if Unity is going to go from undervalued to overvalued to super overvalued, I want to catch all of that. So given that there is a huge margin of safety in Unity right now, right, it just really can't go down any further. I mean, for a hot minute, maybe it could. Unity is dirt cheap. Their AR and VR future is not priced into the stock. Everything is based on the gaming, and they have just such huge commercial and industrial uses for what they do that eventually it's going to matter as things play out over time with AI and machine learning and everything else there. All right. I had old Palantir, Planet Labs. I had old Planet Labs warrants, and I decided that I wanted to get my money out of there. So I sold my warrants, lots of them, a couple thousand in over here, and then more at Schwab. So I no longer own the warrants on Planet Labs. I still have some covered calls on Planet Labs. So we'll see if these get called away from me. I don't really know what Planet Labs is trading at right now. Is it about 4 something? So I might get called away from Planet Labs, and that's a-okay with me. As you know, I don't think that Planet Labs has as much upside as they used to. Let's take a look and see what my Planet Labs puts are. My calls, excuse me. Let me take a look. Come on. Planet Labs. Yeah, I have the January $5 covered calls sold. So just like what I had in here. So I sold the January 5 covered calls. If you're going to sell them again now, you'd want to push it out a few months. Probably sell the April 5s, in my opinion. And that should get everybody back to even. My cost basis on Planet Labs is $567. And then I had, this will be the third or fourth time that I've sold options. So my cost basis, I'd have to take a look at my portfolio analyst, probably around $4, maybe $3.50. So on net, I'm profitable on Planet Labs, and then I just sold the warrants, so that was all free money. Yeah, somebody wants to say pretty bullish on the Planet Labs chart. Yeah, that's short term. I keep looking at these companies and the competition that has come into that market fast. I mean, I really did not expect the satellite market to just grow so fast and get so many competitors so fast. So it's not the early entry first mover advantage thing that I thought it was going to be. The competition has just ramped up quickly. Spire Global is suffering from the same thing. So Spire Global, I have some covered calls, the February 16s I have, and those were rolled from 14s. Spire Global is currently at 15.25. I am a-okay having that get called away from me. Again, I'm not in this for the last double. I'm in for the first 3 or 4 doubles. All right, that's what I'm looking for. I'm looking for the first 3, 4, 5x. Sometimes people buy my stuff when I sell it for 5x, like with Palantir, and it doubles one more time. And they call me stupid because, oh, you missed that double. Yeah, but I bought Palantir at 8. You didn't. So, I'm not really too worried about that last double. Why? There's not a lot of margin of safety in the last double. that's just trying to ride out a trend, and there's value in that. And if you don't know what you're doing when it comes to learning about companies, then just riding trends and trying to duck and cover fast when bad things happen is probably what works for you. But I've been good at getting into stuff early, sometimes a little too early, but that means I get it cheaper. So, I'm not too worried about that. I really like selling covered calls on a lot of things, especially anything in the S&P 500 that doesn't have really good revenue growth or a chance to have expanding margins this year. I think most of the margin expansion happens next year and in the coming years after that. Why? Well, as you're going to learn from CES, which you can watch with me, I'm going to keep my channel open Tuesday, Wednesday, and Thursday. So if you want to watch CES, Consumer Electronics Show stuff, just log in. I'm going to have to take that out. But this week is the Consumer Electronics Show, and there's some neat things that come from that. So I'll be keeping you updated on what I think I learned, and we'll see. But I think most of the benefit of AI isn't here yet. I think that's several years out. Microsoft is talking about $80 billion of data center development for AI. That's going to take years. The thing that's really doing well right now is energy. So don't write cover calls on your energy, because I think that those are the ones that are going to do the best. You take a look at Katera. That's been drifting up here in the last couple of weeks. Take a look at Permian Resources. That's been drifting up in the last couple of weeks, right? They came off those diggers in December, but they're rebounding now. The Invesco Energy Exploration ETF has been drifting up. The Spider Energy Select has been drifting up. So I think energy is the next winner from AI. Because we don't have the supply that people think that we have, and that's going to drive prices up. Europe has had huge drawdowns in natural gas, so that's bad for them, and good for our companies like Katera, Permian Resources, New Fortress Energy, which I pounded the table on a couple months ago when it was under 10. So I wouldn't be writing covered calls on the energy. In fact, I think you can sell cash secured puts on anything where the trend is in your favor. In any case, what kind of questions do you have about option selling today? Anything that you want me to take a look at as far as writing a covered call or even selling a cash secured put? Brandon mentioned Planet Labs, and yeah, I mean, I guess you can say it's a pretty bullish chart from here, but that move from here to here, is that normal? Is that a normal move? It's not a normal move, right? That's very fast. That's an adjustment. That's like going up a stair. So now you have to take a look and say, okay, let's go back to the period since it crashed and take a look. Well, okay, let's add the Elliott wave. So probably going to come down. Good time to sell a covered call. Linear regression still hasn't created a brand new uptrend, but I do think that this is going to be like a teeter-totter, and it will have a shallow uptrend. So the uptrend will be the opposite, right? It'll be the mirror image of this. It's not going to go straight up. Company doesn't support that. So while this trend is down, it'll be, in the opposite direction soon, but nothing special. Lux Algo had a buy signal down here. You got a buy signal from the Wyckoff spring way back here, and it's higher. Took a year, and there really isn't a whole lot. There's no fair value gaps, not really, a little bit here. So there's no new fair value gaps. There's nothing supporting a further breakout. So is this chart good? Yeah, well, it was an improvement, and it's going to change the trend, right? It's going to change the trend from here, something like that. I mean, that's not exactly, but you got to figure out what are the relevant points. I think these are probably where are going to be the new baselines. Will this go up? Yeah, maybe something like that might be the new trend. That looks actually about right. So yeah, maybe it's got upside to 7, 8. I don't think those warrants are ever going to cash. I mean, how does Planet Labs double in the next 2 years? I don't see it happening, especially if liquidity is tight and there's not enough interest in this stock from the investing public to make it into a meme stock. There's just too much competition. So I don't see Planet Labs being worth anything. Sell covered calls, you can even trim it, right? I'm selling the covered calls because I like, being whole. And at $5 a share, if you can sell a 50-cent covered call, that's like a 10% dividend, right? And then multiply out for how many time periods there are on that in a year. And there's not a lot of downside. So you could just keep selling covered calls until whenever it gets called away. And it ends up being a good trading stock for that. Somebody asked about Rocket Lab. This is a company that we know. So see this trend? This is what's going to happen with Planet Labs. Can you sell a covered call on Rocket Lab? You can. Here's why you got to be careful. Unless it's a huge position for you, I don't think you should be doing it. Why? Because we know that this stock can get over 100 billion in market cap at some point, and this is going to be a big company. There is virtually nothing that says that it won't be a big company. Everything is moving in that direction. They're on the verge of profitability, which is when the next big leg up is going to happen. And if you want to be cutesy and you have a big position, could you write like a $40 covered call? I did that. I mentioned that the other day, and I even showed it to you. So I wrote the April $40 covered call, and I got 335. But I only wrote it against a little piece of my position because I do not want that stock getting called away. So again, you only write the covered call if you have a huge position. And for me, I loaded up on it when it was in the single digits, and it became a double-digit percentage portfolio holding for me. But if your holdings are in that 6, 7, 8% range of your total net assets, you just hold your nose and you wait for the next double or triple a few years out. If you have 11, 12, 13, 14% of your money in Rocket Lab, yeah, then go ahead and write some covered calls against it. All right. So I guess I shouldn't say you're asking about the wrong stocks, but I've covered this before, but I guess it made sense to cover it again. You shouldn't be getting cutesy with it. If you go a single digit position, you probably should not be writing covered calls. This is a horse that you ride to the finish line. Yeah, somebody mentions that we killed it selling puts on Rocket Lab when it was down around $5 a share. Yeah, I mean those internal rates of return were, I think, around 100% on the year. So that's huge. When you get these opportunities, right? You see charts like this all the time. Our job is to know, is this going to happen, right? Is this going to happen? In hindsight, so let's take a look at Tesla. Just want to take a look at a 5-year chart of Tesla. Actually, go out a little further. Let's get rid of some of this silliness. There were people, right, and we were among them, selling puts on Tesla and buying here. See this first move, right, from below 20 to above 40? And people are saying, oh, should I sell covered calls and sell my Tesla? Looks the same. It looks pretty much the same as Rocket Lab now. So are you going to get a little dip? Maybe. But then look what happened. Well, I don't think any of this stuff up here is justified. Look at the bottom of these fair value gaps. They're all around 200. So Tesla probably should be a $200 stock, give or take. Go back. This is when I first discovered Tesla. Look how long it took. And I was mainly a seller in here, and I shorted up here, and I'm thinking about shorting again. And I think Tesla's going to have a shit year. I think this stock comes back down here, right? So this area in here, see the bottom of these fair value gaps, pretty consistent. So somewhere in here is probably where Tesla's going, lower 200s. It's expensive to short this stock, and it's risky because the people who bet on this one, they are pure gamblers. They say that they're not, but they are. They're all gambling on the side. They're all betting on presidential elections. They're all talking their book. They don't know shit from shine about what they're talking about. Shinola, if you want the brand name. And yeah, this one's got to come down. I don't know that there's an easy way to trade it, a less risky way to trade it. I don't think it exists because it's expensive to short. But if you own Tesla, you don't even want to sell covered calls up here. You just want to sell maybe half of your position, and maybe you want to write a covered call that goes all the way to next January so that you are selling again into another tax year if it keeps going up. So let's suppose I had a 10% position in Tesla. I would probably sell half of it, and then I would sell like $500 covered calls to next January. So what could you get on next January's covered calls for Tesla? And I'm just doing this for example because it's a great one to take a look at. The stupidity of a lot of the investors out there. It's just kind of off the charts at this point. Take a look and say, okay, what are the, come on, what? Did you see that? Stonks. So we go out to January of next year, January of 26, right? If you wanted to spread your taxation over multiple years, you go all the way to, heck, you could write $600 covered calls against half your position. So you wouldn't get called away until 600. You get $55, right? 55 into 400. I mean, that's 12.5%, 13.5% return, give or take, for a year. And that's just on the income. And by the way, the stock can go up 50% for you. Yeah. Sell these long-term covered calls against what you can't sell right now, right? Sell as much as you would need to reduce your risk and, balance that with your taxation. Then you could write a covered call. I would probably write, well, look at those deltas. Yeah, I don't know. Maybe the 550? Kind of hard to say. I don't think that Tesla really has any upside. I mean, like zero. Doesn't mean that it won't happen, right? The idiots might push it higher. Yeah. Okay, so a couple more questions. Quantum stocks. I have mentioned this every week. I think you need to ask yourself why you're asking about it today. I talked about quantum computing after the 2020 CES, and now suddenly a bunch of those stocks have rallied straight up. Why would you think about it now? Why would you think about it now? We know that the technology is not going to be there for years. You were in the first hype rally. Think of the Gartner hype cycle. You should have bought these stocks 2, 3, 4 years ago, and then you should be selling into this rally, right? That's what you should have done. You need to stop chasing. If you're a chaser, you're just a gambler. And if you're a gambler, you better have a good system. That means you better be a star technical analyst. Stop thinking about chasing things. Buy tomorrow, today. Don't buy yesterday, today. Do I expect a 20% drop in Bitcoin? I don't know what I expect with Bitcoin. What I know is that there is a direct correlation, and I'll show the chart again. I don't think it's easy for me to get to. Well, since I'm going to be editing this out anyway. Ooh, there it is. There you go. Global M2 against Bitcoin. And this actually correlates to the stock market too. Look at the time lag here. I was talking about that 6 to 12 month time lag. When liquidity goes down, asset prices follow. Up or down, asset prices follow liquidity. I don't know what could be a more clear chart than this. Global M2 is the white line. Bitcoin has followed it. And I can do this chart for the stock market too. Stock market follows it as well. Again, a 6 to 12 month lag, long and variable legs. So we should expect Bitcoin and the stock market to come down or start coming down by the middle of the year, but I think it's sooner than that. I think when the Fed doesn't lower interest rates in January, I think that's it. I think that we start to see things start to roll over pretty hard. Granted, the market's not expecting Jerome Powell to cut in January, so maybe it's the next time that they're disappointed, right? Because they've kind of coached themselves into being okay with it this time. But if at the meeting after January, right, in March, if he doesn't cut rates, then people might freak out. Long-term rates have been drifting up. That's kind of stupid, but everybody likes to thump their chest about inflation, even though that hasn't really been the problem in a very long time, right? We had the little bit of bailout inflation from COVID and supply chains breaking from COVID, but the secular trend is disinflation and deflation. And we're going to get more and more waves of that as AI and machine learning and alternative energy come online. It's just this transition period that people want to talk about inflation because they don't understand it in the first place, and they don't understand that it is in fact transitory. Eventually, we're probably going to see prices decline, hopefully in one big step down, right? A nice crash and recession. But if it drifts down because the politicians and the central banks try to manage it too hard, it'll just be a slow unwind over many, many years, in which case we could get a lost decade in the stock market. And I don't put it beyond the politicians and the central bankers to be that stupid. I mean, we'll see. We'll see. I think there's some smart people out there that know that you let it crash and then you rebuild it over a very long period of time. It's better to have a crash and then a 10-year expansion than a 10-year unwind, right? I mean, that's horrible. That's horrible. I can trade it, but 90% of people can't. So just understand this correlation. I don't know. I mean, if I hit you in the head with a brick, that would hurt, right? Take a look at this. This is a brick. So I did trim my Bitcoin holdings again. I am managing other people's money. I have to do things like that. Do I think that Bitcoin is 300,000 after the next QE? Yeah, I do, right? Because then this just go way back up. But between now and then, yeah, you're going to get a dip. Could it be 20%? Yeah, it could be 50%. So you have to decide what's important for you. And the reason why I said don't write covered calls on IBIT is because that locks you into the time frame. I think that you should just manage the position based on your risk tolerance and how much you want to trade. So if you think that, hey, I've doubled or tripled my money on Bitcoin, because we bought it way back here. We've done very well on Bitcoin. And we bought it way back here, loaded up, backed up the truck. So if you didn't take any profits here, but now you got this next leg up, maybe you should take some profits. Maybe you sell a third of your position. That's basically what I did. Sold a third of my position. Why? Because it's free. At this point for me, it's free. So I can hold the Bitcoin I have forever in perpetuity. And even if it goes to zero, I'm even. And that makes it real easy for me to ride this out if it does fall more. My expectation is I buy it all back cheaper this year sometime, maybe early next year. So as this correction takes place, I'll buy it back. You have to decide, do you want to play this cycle? Do you want to play this part? Do you want to play that part? I think, especially if you got in with us down here, you should probably sell 1/6 to 1/3 of your Bitcoin holdings. If you're a really good trader and it's in your general approach, right? You've got experience trading more, then go ahead and trade more. Maybe you sell 2/3, right? I don't think M2 is going to come down much more. I don't. I think it's going to jitterbug. And then when this comes down, by summer of 2026, global M2 is going up dramatically. Why? Jerome Powell either is getting rid of quantitative tightening by then in an effort to keep his job, or whoever replaces him, which I think is the more likely thing, whoever replaces Jerome Powell in May of 2026 probably not only gets rid of quantitative tightening if it's not already gone, but does quantitative easing. And again, remember, it's a special facility, not quantitative easing, because they don't want to call it quantitative easing. So we have $1 trillion special facility for the repo market, and they just keep reloading it because they've used part of it. And that's why financial conditions loosened up a little bit in the last 6 months is, they use part of a special facility, don't call it quantitative tightening. All right, let's call it a day. I wasn't supposed to be here. I thought I'd be doing stuff and things, get my house back in order. So Mondays are really retirement income options from here going out. Come by on Wednesday for the major markets asset allocation. And then I'll be posting stock and interviews and other sorts of webinars, videos going forward. So on Mondays, this is, you can stop asking me about other stuff really, because I'm not going to answer anymore. That's for the monthly program, and that's for the chat rooms because those are more real time and then everybody can read them. And I want to really dial back how many of my stock picks I'm giving away for free, because I know that there's people who been getting a lot of stuff for free from me, and you guys all pay for it. So we're going to give you the stuff, but that means it has to be behind the paywalls. All right. Have a good rest of your day, and have a good New Year. See you Wednesday night.